Hello, everyone, and welcome to our mining webinar series, part of the celebrations leading to the 20th edition of the Brazil-Canada Mining Conference at PDAC 2026 in March in Toronto. The Brazil-Canada Chamber of Commerce, BCCC, is an independent and nonprofit organization that has promoted business relations between Brazil and Canada for over 50 years. In 2026, we celebrate 2 decades of connecting the mining sectors through our exclusive high-level events at PDAC. In the chat, you will find our event program, including the agenda and opportunities for companies interested in participating in this amazing edition. And of course, I want to thank our annual and PDAC sponsors. Our platinum sponsors are Valley, Rio Tinto, and TMX Group. Really, we are grateful for your participation. Our gold sponsors are Mellowhawk Logistics, G Mining Ventures, and Wheaton Precious Metals. And of course, our silver sponsors are Brookfield, BMA Law, and Proactiva Results. To all our members and partners, we thank you for your continued support. Before we start, I always like to acknowledge that this is the land where we are part of, is the treaty lands and territory of the Mississaugas of the Credit, the territory of the Anishinaabe, the Huron-Wendat, Haudenosaunee, and Ojibwe-Chippewa peoples, home to the Métis and most recently the territories of the Mississaugas of the Credit First Nation. We are grateful to have the opportunity to live and work on this land. Finally, we have a DEI statement for the BCCC, so together we stand as leaders embracing diversity, equity, and inclusion. We recognize that DEI is not just the right thing to do, but essential for our organization's success. We lead the change, understanding that diversity and inclusion practices must permeate all aspects of our business. By weaving DEI into the fabric of our organization, we cultivate an environment where every individual thrives and feels a sense of belonging, innovation flourishes, and collective potential is realized. Let us forge ahead, united in our mission to create a diverse and inclusive future that transcends boundaries and elevates us all. Lastly, for this webinar, organized with the Toronto Market Exchange Group, we will spotlight how junior mining companies can access capital and leverage cross-border opportunities between Brazil and Canada. I am pleased to invite our great partner, Guillaume Lagaré, Head South America, TSX and TSXV, to guide this conversation. So Guillaume, this stage is yours.
Thank you so much, Peter. Thanks to the BCCC for this virtual opportunity. It's better to be virtual. I'm currently in Expo Zibran in Salvador, Bahia. There's a mining conference here, lots of people around. We opened the TSX from here this morning. You will see it live tomorrow morning. So it is a very important event for us. And it's also important to take part in this panel today. As Peter said, I'm heading the LATAM activities for TSX Venture Exchange. I'm based in Sao Paulo. And in recent months, we had a lot of roadshows and matchmaking sessions with investors and project owners, junior mining companies. And I thought that it would be useful to bring in my 2 colleagues, Richard Goodman, who's the Global Head of Capital Development for TSX Venture. So Richard looks after the CPC program that we call the Capital Pool Company program, and will provide some information about the CPC program. And Luc Arsenault, who's Senior Manager, TSX Venture. He's our geologist, he's our expert. He's a very important resource when companies want to discuss the 42-101 report or any kind of information ahead of listing or when a company is already public. So we wanted to use this time, I think we have around an hour or a bit less, to provide you with some information about our markets, the CPC program, and the 42-101, the listing requirements. So we'll try to cover as much ground as possible, but of course, you will know where to reach us if you have additional questions. We might have a little time for questions, but let's try to cover enough ground. I will just start by sharing my screen and presenting presenting our markets very briefly. I hope you can all see my screen. So we are the Toronto Stock Exchange and the TSX Venture Exchange. We did mention for this presentation that we're talking about the junior mining sector, but I think it's important to mention that we're a 2-tier ecosystem where issuers can list initially on the TSX Venture and then graduate to the main board, our TSX main board. And I will explain later what is the size of those markets for the mining sector more specifically. We're one of the top 5 global hubs for equity capital. Canada, UK, Australia, US, and China We have raised over the past 5 years 170 billion, close to 170 billion in equity capital. So we are, for Canada, with a population around 40 million, we're pretty much a very strong capital markets to raise capital for on the TSX and TSX Venture. This is how we can say that we're a diverse market. Mining, we're not just a mining exchange, as you can see here. Actually, mining, which represents around 12 or maybe more today of our total market cap for TSX and TSX Venture, we have close to 3,500 issuers. And I would say we have close to 1,100 issuers just for mining. But what's interesting is the total market cap of the mining sector has reached at the end of September, $1 trillion just for the mining sector. So it is quite an achievement. We believe that this will also open, create a solid ground to list new companies, new junior mining companies. And the idea for today is to share some information about our markets so that the mining sector has become quite a strategic area where companies can raise capital these days. But we're also an exchange that is important for energy, 16%, financial services. And so I would say that for Latin America and for Brazil specifically, mining and energy are the two sectors where we can play a very important role, and increasingly also around the innovation sector. So it's interesting to see that for mining, we have 54% of our TSX issuers, on the main board, the TSX, are graduates from the TSX Venture Exchange. We had 41 new mining listings in 2024. So far this year, we have around 36 at the end of September. We have a whole ecosystem that is really supporting mining, over 250 analysts, and 40% of the global public mining companies are listed on the TSX and the TSX Venture. So we are the #1 mining exchange. These are the numbers for 2024, but just to provide you an update also on the year-to-date results at the end of September 2025. So we have raised around 7.6 billion on the TSX and TSX Venture so far this year, with 36 new mining listings. So this is pretty interesting. We saw in 2024 that the total market cap, the total capital raise, was about 50% was mining, 10.4 billion out of the 20 billion. And in 2025, also mining is a very important part of the total capital raised. Let me compare also with the competition. In 2024, we have raised 10.4 billion, which is more than ASX and all the other exchanges in terms of mining capital raised. So this is quite important to know that we're in a leading position as well. So these are the numbers, and we will share the presentation afterwards, but just to provide you some insights about our new mining listings, the number of issuers, the market cap. Actually, the market cap has increased quite a lot since December 31st. It is now $1 trillion for the mining sector, as I mentioned initially. And also, we are a truly global mining exchange. We have over 5,200 mineral exploration projects on the TSX and the TSX Venture, but 48% of this total is outside of Canada. And so 52% are in the Canadian market, 48% globally, and Latin America is the most important market for us outside of Canada. We have 401 issuers with over 1,000 properties across Latin America. And we have raised $5.7 billion in 2024 for issuers with properties across Latin America. And I will just do a quick overview of the different markets. In Latin America, 123 issuers, 339 properties. Here comes Peru as a second market in terms of number of issuers, 55 and 121 properties. 52 issuers in Argentina, 157 properties. And Argentina right now has, with the midterm elections, the Milei administration, we were seeing a lot of developments around the Argentina mining sector. So this should be quite positive for overall on our markets. Chile also is an important market, 44 issuers, 127 properties. Brazil is ranked at 30, actually it's 38 issuers and over 100 properties in Brazil. So we can do much more, to bring Brazil closer to the other mining jurisdictions in Latin America. And that's one of the reasons why we have a full-time presence here in Brazil to try to align or to better connect projects with capital on our markets. This is Colombia, 21 issuers and 49 properties. And this is where maybe the slide where I will be able to to pass the microphone to my colleagues. There are different ways you can go public. We believe that the Capital Pool Company program from the TSX Venture is certainly a very efficient way where a company can list on the TSX Venture exchange. Really, what we do is we connect projects with capital, with the CPC owners, the CPC founders, and Rich Goodman will explain more in more details the CPC program. And also we'll have Luc that will explain in the upcoming, after Richard Goodman will explain also the listing requirements and also the necessity for the 42-101 and the role of the QP. So I think this is how I wanted to end my very short presentation. And I think I'll pass the mic to Rich Goodman that will be able to explain in more details what is the CPC program and why we believe this will be a successful way to raise capital and list on the TSX Venture Exchange for a junior mining sector and projects. Over to you, Richard.
So I'm going to be talking about the Capital Pool Company or CPC program today. The CPC program is uniquely Canadian listing vehicle that helps earlier stage private companies go public through a two-step process. In a CPC, experienced founders from a shell company with no assets other than cash and list it on the TSX Venture Exchange to raise seed capital. That public shell, called a CPC, then seeks out and merges with a private operating business in a qualifying transaction known as a QT. It's effectively a reverse takeover, allowing a private business to access the CPC's funds, shareholder base, and public listing. After the QT, the combined company continues trading on the venture exchange as a normal listed issuer. So why a CPC and not a traditional IPO? Some companies prefer the CPC route over a traditional IPO for several reasons. Unlike an IPO, a CPC offers greater flexibility, certainty, and control over timing and pricing. Since the CPC is already a publicly listed company, the process for the RTO could result in less regulatory rigidity, which can make the process faster and simpler. In practice, this means a private company can work more closely with a small group of investors and directors to tailor the transaction, rather than conducting a broad underwritten offering. Some of the other advantages include gaining an experienced management and board. By design, a CPC will be created and led by seasoned directors and officers with public company experience. Also, getting access to capital and liquidity. The CPC first completes an IPO to raise a pool of cash. This ensures funds are immediately available for the qualifying transaction and gives existing shareholders liquidity without needing a full IPO. Lastly, there is mitigation of IPO risk by doing a CPC. Because a CPC can raise money without a broad public distribution, some market risks of a traditional IPO are reduced. Since the CPC already went through an IPO process, including getting the requisite number of shareholders on board, the process to raise capital for the IPO can be much more straightforward. The CPC program has a strong history in Canada. Since its inception, over 2,800 CPCs have been created on the TSX Venture. About 85% of these CPCs successfully completed a qualifying transaction and became operating public companies. Collectively, former CPC issuers have raised over $83 billion of equity by the end of 2024. And about 1/3 of all venture companies that graduate to the TSX began their life as a CPC. These statistics underline that the CPC model is the most common way to go public on the venture exchange. In 2024 alone, former CPC companies raised over $2.2 billion of new capital in their public growth stages. In fact, 40% of new listings on the venture in 2024 were CPCs, reflecting the popularity of this route. In short, the CPC program has an incredible track record and has helped many startups become established public companies. Forming and listing a CPC involves a few key steps to ensure credibility and public float. First is the seed capital stage. The CPC founders, their directors and officers, must invest personal funds into the new company before the IPO. Current TSX venture rules require that at least $100,000 or 5% of the proceeds, whichever is higher, to come from the CPC's directors and officers, with each of them investing at least $5,000. The total seed financing could be up to $1 million. For example, an illustrative CPC might have 3 founders, each investing $35,000, and an institutional investor adding $125,000 for total seed capital of $230,000. We're going to show this on the next slide. This aligns with the venture's requirement that seed shares be issued at a minimum price of 5 cents or 50% of the IPO price, whichever is higher. The next step is the initial public offering of the CPC. After raising the seed capital, the CPC conducts an IPO. The minimum share price for this IPO is 10 cents, and at least $200,000 of funds must be raised, with a maximum of $9.5 million. In practice, many CPC IPOs may raise only a few $100,000, enough to cover its share of the expenses connected with the next stage for listing the qualifying transaction. We're going to show you an example of such a transaction in the coming slides. Note that the CPC, it must meet regulatory public float requirements. The IPO must create sufficient public ownership. The CPC needs at least 150 public shareholders, each holding at least 1,000 shares and at least 500,000 free trading shares in the float. But the post-qualifying transaction will require 200 shareholders, so the CPC usually sells to 200 shareholders in its IPO stage. As discussed on the previous slide, the CPC program is essentially a 2-step market entry. Step 1 is a CPC formation and IPO. A CPC is formed by veteran directors, raises seed capital, and completes an IPO on the TSX Venture Exchange. At this point, the company is publicly listed but holds no active business, only cash. This stage connects the company with Canadian investors and provides working capital for the next phase. Step 2 is the qualifying transaction. The CPC then searches for a suitable private business to acquire or merge with. In the QT, the private company effectively acquires the CPC via a reverse takeover, otherwise known as an RTO. The operating private business is combined with the CPC, and the CPC's cash is used to provide funding along with any new private placements to the combined entity. Once the deal closes, the combined business continues trading publicly under the CPC's listing, but with the private company's operations as the core. Often the ticker will change to reflect the new operating entity. After the qualifying transaction, the CPC's original cash balance has been invested in the acquired business, and the board is typically refreshed to include representatives of both parties. Crucially, the shareholders of the private company usually become the majority owners of the new public company, preserving control. In other words, the private company shareholders accessing the capital, shareholders and expertise of the CPC to complete the listing while retaining a controlling interest. The CPC's founders and seed investors take a smaller percentage of the new entity in exchange for providing the listing vehicle and initial capital. There are 3 concrete groups of shareholders in a completed CPC. First are the CPC founders and the CPC's IPO investors. Let's call all of those together CPC investors. Second are the current shareholders of the private company that is looking to complete an RTO of the CPC. Third are the new shareholders that invest in the new entity formed by the combination of CPC and the private company. After the transaction is completed, the CPC founders may own anywhere from 1 to 10%. This slide shows that there's 5 to 10%, but that really does impact every situation is unique. So each individual situation may result in anywhere from 1 to 10% of total equity owned by the CPC founders in the ultimate transaction after the qualifying transaction is funded. In lieu of time, I'm just going to skim through these slides, but really what I want to highlight here is that there are 3 distinct phases. One is the seed investor stage. In this example, we've invested $230,000 by the CPC founders. The second stage is the IPO, where in this instance, a total of $230,000 was invested initially. Another $300,000 was raised in the CPC's IPO round, totaling $530,000. And you can see the total number of shares as a result. Then what we have in this particular example is a private placement of $10 million. The value of the qualifying transaction, the company that is the operating entity, was valued in this situation at $30.8 million. With the seed investors, the CPC round, the private placement, and the value of the operating company, we can see a post value of this company at $41.7 million. And the seed investors, the original CPC investors, only own 1.3% of the ultimate organization. So, in conclusion, the TSX Ventures Capital Pool Company program offers an established, flexible way for private companies to enter the Canadian public markets. It provides immediate capital and experienced directors while allowing the company to keep majority ownership. It helps manage the cost and complexities of listing, often lower than a traditional IPO, and mitigates certain risks. The program has a strong track record on TSX Venture, and for those considering growth capital, the CPC route should be viewed as a proven vehicle for scaling. The structure of the QT transaction ensures continuity for the operating businesses while opening access to North American investors. For those interested in pursuing this strategy, we can help connect you with Canadian Securities Council, financial advisors, and CPC partners to help you begin preparing the required documentation and start the process. Thank you very much.
Thank you very much, Rich. This is really interesting. We have a very pragmatic view of the markets and how we can help companies connect with CPCs and capital. And I think the bottom line is we will help junior mining companies be ready to meet with the CPCs. The CPCs, by definition, they are looking for a qualifying transaction in a period of 6 to 12 months, to 18 months, maybe, in terms of their patience, in terms of listing new companies. The list of the CPCs is available, but usually when a junior mining company wants to list through a CPC, they can reach out to us. This is what we did for the roadshow. We can look at the quality of the asset with the help of Luc, our geologist. We look at the quality of the management team. We look at the ESG program, and we can start looking at a way we can connect those CPCs with the project. So this is what we did last March and April when we went to Brazil, Argentina, and Chile with the CPC investors. And this is what we're doing also in a few weeks in Argentina. But the program is always open for new opportunities. So don't hesitate to reach out to us if you want to apply and meet and connect with CPCs. So I think we were ready to move on to Luc, that will explain in more details the listing requirements, the 42-101, and the role of the QP. Thanks, Rich, for your insights, and we may have time for questions after Luc's presentation. Over to you, Luc. So Luc is the senior manager, TSX Venture. He's geologist, and he's our expert around 42-101 and the listing requirements for mining. Thank you, Luc.
Okay, thank you, Guillaume. So you can see my presentation.
Yes.
Yes.
Thank you. Okay, so thank you, everyone. Thanks for being here. I'm happy to present this part of the session. So yes, I'm a geologist with the Toronto Stock Exchange, so the senior market, the TSX, but I also give a helping hand to my colleagues on TSX Venture for any review of technical reports or sometimes the listing requirements. So in this presentation, I'll be focusing on these three subjects. However, Guillaume and Richard really touched well on why and how to list on TSX, TSXV, so not much more on that. Then I'll be covering the National Instrument 43-101, so the standards of disclosure for mineral projects, followed by the specific technical report triggers and requirements. Just high level, Rich touched well on the different paths to listing, and ultimately those paths will lead to the senior listing on TSX or the TSX Venture. So I won't go through those processes because they were well covered. But those are the opportunities to the listing of mining companies. So chiming into the more specific listing requirements, and again, this is focused on mining. This is general for any listing, but also focused on specifically for mining requirements. So obviously, for a mining company, need to see a property ownership there. We're going to be looking at the management. So what kind of a track record did they have? Do they have public company experience? Do they have technical experience? And then we'll focus on the financial side, so the working cap and the mine life, depending on whether that's an early stage project or an actual operating mine. Any listing will come necessarily, and any mining listing will come necessarily with the support of technical reports. So we'll list companies that have projects that have disclosure that's supported by a current technical report. And then, of course, the listing occurs depending on the stage of advancement. So that's quite unique to our market. We offer the opportunity to list for a mining project that needs very low capital requirements to advance to the next phase. So $200,000 work program, for example. And then we also list on the senior market the more advanced or producing operations. So here I'm just going to go through the listing, the technical and financial listing requirements for mining projects. And because we operate the two markets, TSX Venture and TSX, well, I have here on the left-hand side of the slide, the TSX Venture listing requirements, on the right-hand side, the TSX listing requirements. So and I'll focus TSXV to start with. So 2 tiers are available on TSXV, but in any event, no matter what category or what market you're listing on, the property interest of at least 50% is a general requirement all over. But then, okay, so we focus on TSXV. Tier 2 property. What do we mean by a tier 2 TSXV property? Well, it's a property on which there's at least $100,000 of prior approved expenditures over the last 3 years. It's also a property where the technical report will have a recommendation for a work program of at least $200,000. And so that's the tier 2 requirements. If we focus on the tier 1, TSX Venture tier 1, well, it's a tier 1 property which has at least a resource estimate. So we're beyond the grassroots early stage. There's been drilling. There's a resource estimate. So that's your tier 1 property. And that property needs to have a work program that is recommended in the technical report of at least $500,000. So that takes care of the property requirements on TSX Venture. If we focus on TSX now, so more advanced project, at least a 50% interest, of course, but again, at least a resource estimate that's supported by the technical report. The work program minimum in the case of the exploration on TSX is currently 750,000. But be aware that this is going to be increased likely in November to a minimum requirement of 5 million. The $750,000 was a bare minimum established back in the 90s. So of course we're revising and making our requirements current. So that will become a minimum requirement of $5 million. And then the second category, the other category on TSX, is the producer category, or a category or a company where a company has made the decision to put into production a project or has been in operation and is generating revenues. So ultimately, that type of project, we have a technical report that supports proven and probable reserves and a minimum mine life of 3 years. So financial test requirements, again, separating the TSX requirements with the TSX here. So if we start with the TSX on TSX Venture on the left-hand side for the tier 2 TSXV requirements, well, so ultimately the question is here, how much cash do we need to list? This kind of captures the requirements. So for tier 2, we need adequate working capital for 12 months. So we want the company to show us in their 12-month projections that they have at least the amount of cash that's equal to doing the phase 1 work program. So that's a minimum 200 grand we saw in the previous slide. And then whatever the cost of G&A, the listing costs and everything. And then over and above that, we need to see a buffer of $100,000 of unallocated funds. So it's a cushion to make sure that the company has a bit of leeway over the 12-month period. So that's the tier 2. Tier 1 requirement is, well, we're looking at projections that are not 12, but 18 months. And the buffer here that we need to see is at least $200,000 of funds that are not allocated that act as a cushion for security. So that's kind of the financial requirements on the venture side. For the TSX on the exploration category on the right-hand side, so the minimum working capital, we want to see at least $2 million. Again, we are looking at projections based on 18 months. Minimum work program we saw earlier in the previous slide was currently 750,000, but that's going to be bumped up to 5 million. So that is the financial requirement for the advanced exploration stage on TSX. And then the other category, TSX producer. Well, of course, we need to see production, revenues, and the mine life. And the company needs to be, adequately financed and have adequate working cap to carry the business forward. Management, focusing here on management experience and background. So of course, they need to have public company experience. We generally require to have at least 1 or 2 board members that show positive public company experience. And then technical and industry experience as well. Ultimately, if the projects are in other jurisdictions than Canada, we like to see people that have the appropriate expertise and experience in that jurisdiction. So if your operations are in Brazil, likely there's going to be board members or senior management that are local and know how to operate businesses in that jurisdiction. The management team, well, of course, needs to include a qualified chairman of the board, chairman, CEO, CFO, a corporate secretary. And for all of the insiders, directors, principals that are part of the company, we require the filing of personal information forms. We conduct review on the suitability of the individuals. So we want to make sure that there's a minimum standard of integrity and quality that is met for any of the people that are managing and directing the company. Distribution, I think Richard touched a bit on the distribution, requirements and where you can ultimately get that distribution in the CPC. And but no matter how you're achieving the listing, so whether it's through the CPC or IPO, these are the distribution requirements that are required on both markets. So ultimately for the TSXV Tier 2, we're looking at a minimum of 200 shareholders. Tier 1, that would be 250. On venture, the minimum distribution required of 20% of the shares held by the public shareholders is a minimum requirement. On that side, we don't have that on Toronto Stock Exchange. Toronto Stock Exchange will require 300 public shareholders. And in either case, whether there's a TSXV or TSX listing, generally there's a requirement for sponsorship, but sponsorship is very often and usually waived for the TSXV listing and sometimes waived as well on the Toronto Stock Exchange. And the sponsorship is ultimately a member firm of the TMX group that can act as a due diligent expert in the review of the company and its qualification for the listing. And now moving into the National Instrument 43-101, so the standards of disclosure for mineral projects. I think people may be familiar with NI 43-101. It is, effective since 2001. It's currently undergoing a third review, I believe, and will is something that any mining company that's considering a listing in Canada has to understand and abide by the requirements. And what is National Instrument 43-101? Well, it actually covers all public disclosure, including anything that's written or oral or texted or videoed or by the company on its material projects. So anytime there's disclosure on the company's projects, that 43-101 needs to be respected and conformed with. So it also is a rule that has standardized terms like mineral resources, mineral reserves, feasibility, and PEAs. So those terms must be used and followed. It establishes the qualified person criteria and their involvement, what they have to do or what the role of the QP is in terms of disclosure. And very importantly, it establishes the requirements and the triggers for technical reports, which we will touch on in further slides. So you have a schematic representation of what the rule is here. So on the left-hand side pretty much shows that the rule and the form and the incorporated references to CIM definitions of reserves resource, that's law. It needs to be followed by reporting issuers in Canada. And then on the right-hand side, you have the guidance or companion policy and CIM best practice guidelines that explain a bit of the dispositions that you can find in the rule. So here, in order to understand a bit further what the rule is, what 43-101 is and what it isn't, what's important to understand it's a disclosure rule. So it is not a practice rule. Qualified persons are geologists, engineers. They need to practice their expertise according to their professional associations and follow best practice guidelines. So that's practice. So 43-101 is not practice. It is disclosure. It requires individuals to follow, or it's expected that individuals or qualified persons follow their code of ethics and best practice best practices, but it enforces disclosure. So the objective is to ensure that disclosure is balanced, not misleading. It should be objective and unbiased. The disclosure should stick to the standardized definitions, reserves, resources, whatnot. It is expected, and it guides to the fact that any disclosure should be reasonable, based on reasonable assumptions and clearly explained. And very importantly, information is required to be signed off by QPs, whether that's in press releases or AIFs or PowerPoint presentations, etc. So, and what it is not, 43101 is not a guarantee of quality work. I mean, that is, again, it's in the realm of practice. The work is the practice, so the results end up being disclosed. 43101 is disclosure, but the practice is in the hands of the professional associations, the codes of ethics, and so that's what the rule is not. So the rule is also not a recipe for resource estimations. It sets the disclosure requirements, but it doesn't indicate exactly what methods and how the practice should be conducted. That, again, is in the realm of the practice. And it's not a regulatory vetting process. So many technical reports are filed on CDAR, and they are usually reviewed and commented on when there's a prospectus offering, but not every technical report filed for various reasons on CDAR are reviewed and vetted by the regulators. Qualified person, I think it's important here to touch on the criteria of QPs. So ultimately, a QP is an engineer or geoscientist who meets the following criteria of the definition, which you can find in section 1.1 of the rule. So the individual has an engineering geoscience degree related to mineral exploration or mining, of course. They have at least 5 years experience in mineral exploration, mine development, or operations for mineral project assessment. And they have experience in the relevant subject matter of the technical report. And they are in good standing with professional association. In Canada, that means the provincial professional associations. However, if the QP is practicing outside of Canada, which is very often the case, then they have to be member of one of the foreign associations that are listed in the companion policy to 43101, Appendix A, which is reproduced partly here. You can see the professional association, the foreign association that is recognized under 43101. And not only the name of the association, but it is also on the right-hand side, the particular membership designation. So you need to be registered with the association under these specific registration membership designations. So 43101, the QP, again, touching on the role. So there's an actual disposition in 43101, section 3.1, which states that any written disclosure that's provided by the company, well, there must be a QP that signs off or is responsible for approving the disclosure. So that means everything that's disclosed, written or oral, and news releases, technical reports, websites, presentations, conference materials. Now to focus on QP and independence. So generally for any technical report required for a listing or an IPO, that requires independence. However, when companies publish information or produce information in news releases, presentations, then there needs to be a QP that signs off, but not necessarily has to be independent. So we'll touch on some of the situations where, what do we mean by independence? Well, ultimately, independence, there's certain criteria that are listed in the companion policy where it's obvious that regulators will not accept that the individual is independent. And you have a list here. I'm not going to go through them, but there's a more exhaustive list in companion policy section 1.5. But So again, QP independence required for technical reports in certain situations, but not always required for all disclosure. Now focusing on technical report triggers. We've separated here in two buckets the milestones that are related to the company milestones where technical reports are triggered. And then there's advancement of the property. So as the exploration and information advances, increases, well, we refer to those as property milestones. So focusing on the company milestone, when a company becomes first-time reporting issuer in Canada, usually that's by way of an IPO or prospectus offering. Well, that's a trigger for technical reports. And then filing of the following material information, the following documents generally triggers the requirement to file technical reports as well. So a prospectus, an offering memorandum, a rights offering, or an AIF. These are documents that generally will be required to disclose the mining properties at a prospectus level disclosure, and therefore that means that the information in the information document also has to be supported by a technical report. So those are the company milestones. And then the property milestones, well, of course, if you're moving from exploration to drilling, and then you provide the market with a resource estimate. Press release which discloses a resource estimate will trigger a report within 45 days of that disclosure. Same thing if there's the disclosure of a PEA or mineral reserves. Well, therefore, that is a trigger to filing a technical report, and 99% of the times the report has to be independent, or the QPs signing off on the report need to be independent. Just schematically represented here, the milestones, the property milestones in the stages of advancement of the properties. Now, we've spoken of 43-101, but I want to focus here more specifically on TSXV and TSX requirements. I'll start with the TSXV. So if you're going to be a listing on the TSXV, we saw you can list by an IPO, but you can also list by a reverse takeover, or sometimes it's an acquisition that's acquired. And therefore, those are specific triggers for technical reports in the TSXV corporate policy manual. So these are specifically required for a TSXV listing, and there are some more specific detailed requirements for this kind of a report, but I'll leave that for another time. For the moment, I think it's important to understand the rule has triggers for reports, but the exchanges have their own triggers for reports, and of course a listing or an acquisition, a significant acquisition for TSXV will trigger a report. For TSX, here you have the requirement again for a listing. We will require a technical report, and that will be an independent technical report. That pretty much covers off what I wanted to present, and I'm happy to answer any questions if there are any.
Thank you very much, Luc. That was great. Great presentation, very insightful. And I think most of the people we talk to across the region, they know that the 42-101 is a reference. Companies, junior mining companies, they're always asking, do we need to have this report now? Of course, if you have your 42-101 report, it's much easier to connect with investors, but it's also much easier. Of course, if you choose a listing path, it's something that will be required as a listing requirement, but it's often the way you can start the discussion with investors. So we encourage people not necessarily to have the 42-101 when you reach out to us. You can always share a teaser, a presentation about your project. We can have a closer look at this and give you some advice on how to use the 42-101 and how to produce it, or even raise capital eventually to produce the 42-101. Some of the CPCs are open to properties that don't necessarily have the 42-101 report ready. We've seen this in the recent the roadshow. So that concludes the presentation from Luc and Rich. I think we have very little time, but in terms of next steps, it's about reaching out to us if you want to share your projects. We're always available to look at this. This is our day-to-day, trying to find ways to raise capital for junior mining projects. If you want to raise between 2 and 10 million, you can definitely look at the CPC program, and it will be a pleasure to connect you with the right people. I don't think we have any other questions, but we're also running out of time. So maybe I'll pass it over to you, Peter, if you have some additional remarks.
Guillaume, thank you so much, and I really appreciate that. What I have always learned every time is how accessible you are. It is a real pleasure to have all of you here, making sure that people understand the basics and can take an opportunity to reach out to you and pitch their idea, pitch their opportunity, and you're willing to say, great, let's have a look, or not, and really make it clear to them how it works. So I'm very, very grateful for that. We did have one question, and can I just ask if we can share this question, which is the CPC has 2 years to complete a QT. If not, what are the implications? Is that a question someone could take? Guy?
Rich, you want to take this question, Rich, about the
CPC
maximum?
has 2 years to complete a QT. If not, what are the implications? And Rich, you're on mute. They're great. Thanks.
So, and Luc can add some comment to this. In our old policies, there was a limit of 2 years for the CPC to get completed. And after that 2-year period, there was a process for those CPCs to get extensions to that 2-year process. Since the new policies came out a few years ago, we call it CPC Policy 2.0. That 2-year limit is no longer a constraint. And so CPCs now have much more time to get a transaction completed. So in rare situations, we find that a long process can go on in terms of negotiation and diligence between CPC founders and the private company. And every once in a while, it doesn't lead to a transaction for various reasons. And we concluded that it was appropriate to remove that 2-year barrier.
And also, it's quite important, because it doesn't mean that the CPCs are so patient that they want to wait 2-3 years to do a QT, but we need to put the right projects in front of the right CPCs. But also, it's a proper negotiation. So we need also the CPCs to find the companies to find the right match with the CPCs. So that's why we are quite active connecting people. It's not only a private company doing a reverse takeover of a shell and buying a shell. It's about connecting two entities to do more business and to do this kind of partnership. So it doesn't show in the slides, but there's lots of human touch involved in connecting CPCs with projects, and this is what we intend to do by bringing more CPCs and brokers in Latin America.
Wonderful. Thank you for that. Okay, so no more questions. So on behalf of the BCCC, I want to thank our sponsors, our partners, and our members. And this event is one of the many that BCCC organizes to promote connections in the mining sector. From February 28th to March 1st, 2026, we're going to host our 20th edition of the Brazil-Canada Mining Conference at PDAC in Toronto. And so please check our website and our event program and reach out for more information on sponsorship and opportunities for your company. And of course, we always offer membership and sponsorship opportunities where you can gain visibility throughout the entire year. I want to thank everybody, especially these wonderful people, Richard Goodman, Luc Arsenault, and of course, Guillaume Lagaret, for sharing your insights and making yourselves available for this. If you want to contact any of these gentlemen, I encourage you to reach out to the BCCC, and then we'll decide if you're worthy of getting all the way through to them. And so anyway, all the best to you all. Thank you so much. And looking forward to PDAC coming up. Thank you. Bye-bye.